Hello, everybody. I've had my real estate license for just over 10 years now, and I've been investing in real estate and studying the market for just under 20 years. And I kind of wanted to just give you my perspective on the housing crash, if I think it's going to happen. The short answer is yes, I do think it's going to happen, and I think it's going to happen relatively soon. If you want the long answer, then stay tuned for the details that I've compiled and kind of the data that I've gone through and accumulated over the years. So back in 2005, the banks were preparing for the market crash by canceling HELOCs and personal line of credits secured by real estate. And what that pretty much means is if you had equity in your house between what it's worth and what you owe, they would give you essentially a credit card that you could tap into at any time and just pay a specific interest rate, whatever your HELOC percentage rate is, or personal lines of credit, which you could use and secure it based on the equity that you have in your home. As of April 2021, Chase, Wells Fargo, and Citi are stopping their HELOCs. So you can't take out a new HELOC with any of these companies. So that's one of the reasons why I think the housing market is getting ready to crash, is because the banks are preparing, and the banks have more data than anybody when it comes to real estate. And they're doing the same thing they did in 2005. The crash started to happen in October of 2006, at least in Arizona, I remember. Another reason I think that the housing market crash is pretty soon is because you're dealing with a lot more speculators. Now you don't just have people trying to buy homes, getting emotional, and speculators. You also have large corporations. And when you have $10 billion to spend, it doesn't really matter how much the home is when it's $100,000 or $200,000. You have a certain amount that you have to spend, $150 million a week in the case of Blackstone, and they're just one of the corporations that's been buying up homes since 2012. Actually, probably since 2011. I actually sold my house in 2011 to a large corporation. Another reason, and this is actually probably the main reason, is that the income can't keep up with appreciation. So I just took Phoenix as an example city. The median household income in Phoenix was $57,459. That was in 2019. The median sale price of a home was $282,500. In a year and a half, the median home sales price went up almost $100,000, or around 35%, while interest rates dropped less than 1% during the same time. Arizona topped the nation with 8.4% income growth rate, and that's 8.4% on 57,000 as opposed to 35% on 282,000. So you can see on the right there, in 2021, the median price is $381,000 for a home in Phoenix. This is just showing that Arizona was the largest personal income growth. So the 8.4% that I mentioned on the previous slide, Arizona and Montana both were tied for the highest personal income growth rate for the state overall. So if they can't keep up, chances are every other state can't keep up. For example, Washington and California, where prices are going up just as fast, the income's going up slower. Granted, they probably have higher incomes, so it's harder to get the higher percentage, but look at Montana, look at South Dakota, Michigan, Maine, Rhode Island. So just to do an example here, I did 43% debt to income ratio. That's kind of the absolute max most lenders are willing to do a loan for. And what that means is all of your debts, recurring debts, your car loans, your student loans, your credit card, plus your mortgage, PITI, principal, interest, taxes, and insurance, must be 43% of your gross income or less. Some banks are willing to do 50%, but actually most of them look for about 35% or lower. 43 is kind of pushing it for most banks. They like to see higher credit scores or more money down or something to get that 43% debt to income ratio. But it's possible. I've done it before. So the median household income at $57,459 means that you could afford $2,050 a month in total debt. So the $2,050 a month in principal, interest, taxes, and insurance, that's assuming you have absolutely no credit cards, at least no revolving debt on your credit cards, no student loans, and no other real estate or any other recurring debts. That you're essentially debt-free except for the mortgage. You could afford $2,050 a month at $57,459 in household income. Keep in mind that's median household income. That's not individual income. That's like the household. So what this means is that less than half of all the households in Phoenix are able to afford $2,050 a month or less, and half can afford $2,050 a month or more. And again, that's principal, interest, taxes, and insurance, and that's assuming they have absolutely no debt, recurring debt. So here's two examples, and again, I'm being extremely generous by saying they have absolutely no debt. With the tuition crisis and the credit card crisis and the debt crisis in America, chances are most Americans have some debt. But this is just being very generous. The absolute most someone can afford with 20% down, $105,000 down, is $525,000. Their monthly payment would be $2,050, and for the most part, people don't have $105,000 saved up, but they usually can scrimp together 3% or $11,100. In this case, the most they can afford is a $370,000 house. So keep in mind that's if they have a $100 student loan every month, then that lowers the home price. Instead of $370, it's probably something like $350. So and so on. Another reason is interest rates are already at an all-time low, so there's really not much more to help people afford homes with the median household income or lower. If you lower interest rates, which you pretty much can't lower it much more because the feds loan it to the banks at a certain interest rate, and then the banks usually put their 2% on there as well. So about 2% is about as low as we could expect. I'm sure it could go lower, and even if it did go to 0%, it still wouldn't help that much more. The home prices, you can only afford so much. So instead of $2,050 a month, they might be able to afford $2,300 or $2,500 a month. I'm not sure, I haven't run the numbers, but it still wouldn't be able to keep up with the appreciation of the homes. So this is taking into account revolving debt, which I took out and was doing hypothetical, scenario. This is the actual reality. 33% of households can afford the median home price in Arizona. So what that means is 50% of the people in Arizona have a median household income, but only 33% can afford the median household. So that there's a 17% gap in Arizona of people that cannot meet the median household. If you look at the other states like Washington, there's a 28%. New York, there's 26%. And I think every state is lower than, there's a couple. Maryland and Virginia are the two exceptions. It looks like where actually more people can afford. Oh, look, Delaware, 69%. Okay, so there's a few states. But for the most part, the whole country, the median household income can't afford the median household. And the last reason I'm sure you're all very aware of is the current crisis that the country is, the whole world has been in. And as of March 2021, 2.1 million families are at least 3 months behind on their mortgage payment. And so since then, It's probably increased the amount of people that are behind on their mortgage payment, and the amount of mortgage payments they're behind has probably increased as well. When the eviction moratorium is over, something has to happen with all those people. Even if the government comes in, not every single one of those are going to qualify for the program that they come in. So in conclusion, when you add all these factors in together, it's pretty much inevitable that a housing market crash is going to happen, and I think it's going to happen relatively soon. Once the panic starts to set in with the government's not stepping in anymore, they're not going to put a ban on the eviction moratorium anymore. It has to end at some point, and when that does happen, which it looks like it happened yesterday, technically, August 1st, pandemonium starts to set in. You're already starting to see it, and then there's really no stopping it. Even last year, when certain companies were doing better, like Tesla, for example, they were actually doing better and performing better, their numbers and everything, their stock still dropped. There was no explanation for it. It was just people panicking, trying to cash out as quickly as possible. Now, granted, there was people that cashed out their retirement to live off of because they lost their jobs or something else happened because of everything that's been going on. But for the most part, there was also a lot of hysteria that added on to it.